All right. Well, welcome. I'm excited to give you guys an update on the state of the market and the real estate industry here in our Tri-County area. So I appreciate you guys being here. I know it's spring break, so there's a lot of people that are on the beach, out with their kids, out doing fun things, and yet here we are. You guys are here and present, so I'm glad you're here. Let me add one additional thing here, and I think let me add Brad. I'm going to make you a co-host also.
All right.
Perfect. And let me get go. Actually, let's see. I will do. There we go. Let's see. All right. I'm not able to do that from here. So give me one more second. For some reason, I'm not able to add co-host. So let me do it over here. We will get started, guys. There we go. Brad. There we go. All right, Brad, you are co-host, and Kennedy, so are you. Awesome. Okay. With that, I will share my screen and we will dive in. Okay. All right, here we go. All right, guys. Thank you so much for being here today. I'm going to move you on over so I can see all of your faces. I appreciate your time. Obviously, we're starting to get a quarter of the way into the year, and there's a lot of stuff happening. The timing of this call was really great in that yesterday was Fed Day. So we just had an announcement from Jerome Powell with some updates and some guidance. And what I would say that it's been another roller coaster month this month between our last call and now in terms of rate activity, in terms of just really a barrage of economic data that's been all over the board. And yet, probably, especially for housing, yesterday's housing and mortgage, yesterday's Fed meeting was probably the best it could possibly have been. So with that said, let me dive in. Okay, most of you guys know who I am on this call. So Coastal Living 1 and Coastal Living 2. So let's talk about a little bit of the factors, just what's happened in the marketplace and in the economics of the U.S. and Florida since we last met. Predominantly, these are the factors that we've been dealing with. 10-year treasuries, the rates have took a nosedive yesterday in terms of 10-year treasury rates after the Fed's announcement. So there were some, I wouldn't say it was surprise. I just think that he gave some forward guidance that things probably were going to lead to some further rate cuts this year. So we're going to talk a little bit about 10-year treasuries. We're going to talk a little bit about the rate trends that we've been seeing and the spreads. And the spreads are still a really big factor for us because we still have very wide spreads compared to where they typically would be. If you've opened your 401k anytime in the last week or so, you unfortunately saw that the stock market had a pretty substantial sell-off, and that, of course, pushes bond prices up and yields down. So bad for our 401k, very good for where interest rates are headed. Fed policy, I talked a little bit about that. We'll touch on inflation, and of course, we do have just some kind of mixed signals in the unemployment sector, the unemployment indicators. And of course, with DOGE, Department of Government Efficiency, really making some big cuts at the federal level, we're starting to see some of those numbers trickle in, and that will have an impact. And then the last item is just the tariff trade dance and our impending April 2nd date, where a whole slew of different tariffs come into play. And it's going to be interesting to see, is that going to be a game of chicken, or are we going to actually put those in place? And the reality is, I do think it's still positioning and bargaining, just like negotiating the best price for a house, but time will tell. So let's start off with just what's happened to the bond market. And of course, the 10-year treasury is the economic item that directly impacts mortgage rates. So when the treasury goes up, rates go up. When the treasury goes down, rates go down. The spread is the difference between the two that determines how much different are they. And so you can see here on January 15th, the 10-year Treasury was at 4.8% for all intents and purposes, and that's a pretty high level. Since then, we've had just some mixed economic data, but there are a lot of signs showing that the labor market is starting to soften. There are some signs that the economy is slowing down the pace of growth. And with all of that, that has pushed the bond market down. And that's, we were, as of yesterday, sitting at 4.2%. Now, 4.2% is considered to be a key technical level, which means it's a spot that when you're around that 4.2% range, you don't tend to go through that too fast unless you really get softening economic data. But still, we're down 59 basis points in a very short period of time, so we'll take that. It's just, I'm not sure if we're going to see that 10-year Treasury go too much lower on its own unless we do get weak economic data, probably weak unemployment data. So let's look at how this is coming together. 30-year fixed rates, if you've shopped buyers here this last week and the last couple of days, you know that rates have gotten a lot better. January 10th, we were sitting at 7.25, not a very fun rate to be sitting at. March 19th, yesterday, we dipped down to 6.76, and I saw right as I was getting on here, I saw some 6.7s today coming across. So bond market is still in play after yesterday's discussion. So rates are improving. They're not where we would like them to be. And the issue is that we need rates to go down and just stay down. We do have, this is the first time in a long time that I can say this, we do see new mortgage purchase applications trending upward, and it's trended upward this entire year. So we do have some good underlying things happening in the housing market, but if the challenge has been that those rates, they will come down, they will go back up, they will come down, they will go back up. We just need them to stay stable for longer to see that really have an impact on moving the needle on U.S. resale transactions. Spreads can improve. We are currently, of course, we talked about this last month. Typically, the spread or the difference between where the 10-year Treasury is in a 30-year fixed rate is typically somewhere in that 1.5 to 2% range. For a very long period of time, the spread was very commonly 1.6, 1.55. And in this little more unknown economic environment of not knowing what's going to happen with potential stagflation, not knowing what's going to happen with inflation, employment, there's a lot of factors there. We're seeing those spreads still maintain a little bit of a bigger spread. So the high in June of 2023, this is when we saw mortgage rates that peaked, and some lenders were over 8%. And that's when we were seeing a spread of 3%. Currently, as of yesterday, the 10-year Treasury was at 4.21%. The 30-year fixed rate was averaging 6.76. So our spread's about 2.5%. That's still a pretty wide spread, and that does tell us that the bond traders are still a little ooky about the economic conditions ahead. For the first time in a while, we've had some talk of potential recessionary indicators this year. We've also had the trade wars and the tariff impact, particularly could impact housing if it was lumber or steel costs. So we're watching that closely, and I think that's the bond market hedging just a little bit to say, hey, we don't know what the future's holding, but we're gonna stay a little elevated just to make sure that things aren't headed in the wrong direction really fast. So with softer economic data, we could see rates fall another 0.5 to 1%, and this is almost a difference maker for us. That would put us somewhere in 5.75, 6.25 without any federal fund rate cuts the rest of the year. This on its own would spur demand, and then of course with Jerome Powell's commentary yesterday indicating that there were some rate cuts on the horizon this year. They were back on the table. It's all good economic data. So if we just take a look at historically how, and I show this just because so many times I think your customers think that when they hear that the Fed cut the federal funds rate, I see Brad shaking his head, they go, hey, rates fell. Well, sometimes they fall and sometimes they don't. And you really only have about a 60 to 65% correlation between the federal funds rate and 30-year fixed rates. In other words, there are other things that affect that other than just the federal funds rate. And I said 65, it's actually about 35 is the Fed funds rate and 65 is the 10-year treasury. So the gray line is the federal funds rate. And of course, that's the rate at which banks make overnight loans to each other when they have excess cash. The blue line is the 30-year fixed rate and the red is the 10-year treasury. And this spread right here, you can see that on my screen. This is what we're looking at. And this is when I say that spreads can still come down and help us with interest rates. You'll notice back in some of this period back here, the spreads were pretty tight. And you see that it's just grown, and that's the challenge that we're really experiencing. So to just put a bow tie on that, Fed funds rates changes are not correlation, they're causation. So we have to watch the 10-year treasury almost more than anything else. Now, yesterday was the federal funds meeting, and Jerome Powell made a couple of really key comments. I'm going to read this to you. It says, the administration is in the process of implementing policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. And it's the net impact of each of these changes that will matter for the economy and for the path of monetary policy. So he says, there still have been recent developments in some of these areas, especially trade policy, uncertainty around the changes, and their impact on the economic outlook is high. And this is really the Fed just saying, hey, we know that tariffs could create some short-term inflation, and we're watching it closely. The other thing that I think that really came out of the Fed's commentary yesterday is that they are really watching employment like a hawk. And the Fed has 2 key goals. They want to keep inflation steady at 2%, and they want to keep employment steady at around 4%. And so when you look at those 2, we've had really, really, really good employment numbers, but we've had high inflation. And so that's where they've been a little hawkish and a little less restrictive on policy. A couple of other things that they said. He said he and his colleagues are not in a hurry to cut interest rates amongst the uncertainty, which was a little bit of a mixed signal. Said we're focused on separating the signal from the noise as the outlook evolves. So still a little bit more of a hawkish conversation than what we had hoped for. However, there was some other good news. Twice a year, the Fed releases what they call their dot plot. And the dot plot just says, almost like gambling in Vegas, where do I think, as a Fed member, as a Fed official, where do I think interest rates are going to go by the end of the year? And where are they going to be next year? And when the dot plot came out, Jerome Powell indicated that the Fed was targeting 2 additional cuts this year. Now, he didn't make a cut this time, and it would be unclear if they would make a cut next time or if they would wait till after the tariff tap dance happens. But when we look at the numbers, we had, we had 9 Fed officials that said, hey, we foresee 2 cuts this year. We had 2 that said 3 cuts. I kind of like where they're headed with that one, but I think the 2 is probably more likely. And then 1 Fed official said, 4 said 1 cut, and then 4 said, hey, we're not going to touch anything, which I think would be a little bit of a challenge. So, but they each have their own reasons for these. So it looks like maybe 2 rate cuts are back on the table, which the last time we talked, we were still looking at maybe there was going to be 0 rate cuts this year. So again, good news for housing. Inflation continues to persist. Now, interestingly, the Fed usually keeps its inflation target at about 2%. And this yesterday's meeting, they actually indicated that they expected it to be a little closer to 2.5%. In that inflation numbers, we're seeing energy coming down, and so that's actually helping to moderate the inflationary environment. We do see food prices in the core inflation. The food component is still up. I believe the food component was still up over 7% in this last round. So we ended up 2.8% for the month of February over the last 12 months. Not the 2% we'd like to see, but still closer and not the 8% that we had for a while. And when we look at the change month over month, you can see where that is starting to, last September, of course, it was low, came back up, and we're starting to trend back down a little bit in terms of the February number. So we're going to watch that and see where it goes. This is a, so someone got a good little item on the screen there. This is one of the things that the Fed did indicate that they're watching very closely. The personal consumption expenditure is just a measurement of how much money are people spending. And it has started to go down, and they were a little surprised by that. But they're seeing consumers holding back a little bit, maybe being a little less likely to go spend that extra dollar somewhere. So we're going to watch that. If this were to continue to trend, this would be something that the Fed would be looking at closely and would probably impact a rate cut sooner rather than later, just to kind of ease the lending environment out there. Unemployment, it's just a really fascinating thing, even though the housing market has been in a recession now for really, I mean, we're almost in the fourth calendar year. We're trending right now. The last projections was about a 3.8 to 3.9 million sales pace we're at currently. It's the lowest sales pace since 1995, and it's, when you adjust for population growth of about 72 million since 95, we actually are still we're in the worst sales pace in U.S. history. So for agents, when you feel like it's hard out there and you feel like the transactional data is, or the transaction count is harder to come by, we've got some headwinds that we're still pushing against. So when we look at it here, you can see we did increase a little bit over the January numbers. So we are up at 4.1. They expected it to be 4.2, so we're a little better than expectations, but still, one of the interesting things that the Fed did in the last meeting is they kept their target low, and I think they did that so that they could pivot if they needed to. They did give some advice that they felt like 4.5 was going to be an acceptable range for the year ahead. So it looks like the Fed is paying attention to the fact that we're probably going to have some job losses. We do have the construction industry, particularly the multifamily, so anything over 5 units. That segment is really in a recessionary low in terms of new housing starts and new permits. So that's usually a canary in the coal mine for when we start to see some pre-recessionary signs. So again, it's something to just really watch. And then of course I said stocks sold off. Dow 500 was down about 7%, and that really had an impact on the move to the bond market and bond prices. So a little bit of an ouch. I saw today it was making a little bit of headway back up. However, it was a pretty good sell-off. Now, we've talked about this before. This is the challenge that we have, is that when you look back at the last 5 years, the average appreciation of a U.S. home has been about 41%. But wages haven't kept up with that, and you've had some of the fastest increase in interest rates in U.S. history. And so when we look at this, we really just have an affordability issue that we're still bumping up against, and we just haven't been able to get out of that same cycle that just keeps repeating over and over. So with your customers, this is a really good time as rates start to come down, and I'm going to talk a little bit about this. This is a really good market to really be talking about interest rate buy downs. And when you're negotiating transactions, a 1-1 or a 2-1 buy down could be the difference in getting someone to buy today when there is more inventory and still be able to preserve that lower rate that they'll probably have when they can refi it in a year or two. So there's some strategy that you can use. But when you look at this, this is between 2021 and 2024. I've showed this slide before, but your principal and interest has increased 72%, and the amount of income needed to qualify has increased by 46%. Just it's the path is the math, and it's just things are expensive right now. And I know that I've heard several instances of sellers that are actually downsizing, that their payment would be more after they downsize than it is currently. And so you've got a little bit of that lock-in effect. We do have somewhere between about 1.2 and 1.7 million transactions that have not happened over the last 3 years that eventually will creep into the system. People got married, they got divorced, they had children, they're busting at the seams, they've relocated, they're renting. And so at some point, we're going to see those start to enter back into the marketplace. And yet it feels like it's just still a slow trickle. So if we take a look at the national housing market, just what's happening at the national level. Right now in the United States, the median list price across the US is $439,000. When we look at this, we can see when you look at the US as a whole, we're still in a little bit of a seller's market nationally. And you've got areas like Connecticut that still have just ridiculously low inventory, multiple offers. And of course, we're not in that situation here, and yet there are areas that are that way. Price per square foot still is trending up. I'm not a fan of that metric, but the trend shows us that, hey, prices are still moving forward. Average days on the market currently is 115 in the US. So what is that, about 4 months, a little under 4 months total. And of course, median is sitting at 63 days. And that's evidence that we've got a lot of new listings that have come on the market in the new year. We're entering that spring housing market. And this is typically when we start to see the sales pace really pick up and a lot of new listing inventory coming on. Price decreases nationally for single families. I'm gonna share condos next with you. We're sitting at about 34%, which historically, that's the actual historical number. So price reductions nationally are about where we'd expect them to see. Now, Florida is a tale of, of two markets. And when we get into those numbers, you'll see what I mean. And then currently inventory is sitting at 655,625. Now this data comes to you from Altos data. They track every listing for sale in every market every single day. But the difference that you'll see in this data versus NAR or even some of the other data sources that even I use is that they only track properties that can actually be bought and closed on in like the next 30 to 60 days. So if it's a proposed construction, NAR may count that as a unit, except you really can't add that to the sales base until, a year and a half or 2 years later. So these are available inventory. And when we look at some of these trends, on the left, you have February, and on the right, you have March. You can see the median list price actually inched up a little bit from 429 to 439 nationally. Price per square foot inched up a little bit also. The median price of new listings went down just a little bit, which is an indicator that sellers that are entering the market today are a little more competitive than the sellers that were left over from last year's inventory. Price decreases, we're still sitting in that 33, 34%. And you can see that the inventory did grow from 640,000 to 655,000. Now, typically the US for single family resales, we typically have somewhere between 1.2 and 1.4 million total resales available. So we're still sitting at only half of the inventory levels, and yet we're almost 2.5 times the savagely unhealthy lows that we were running back in 2022. One item I see on this also, rents have softened. So you do see rents nationally starting to come down a little bit. That's an indicator that, we've kind of hit a little bit of a peak in what renters are willing to pay. Condo market nationally, we're still in the seller's advantage. The median list price of condo is 380. When you look at average days in the market, 125. So it's taken stuff a little longer to sell, and 32% of those have taken a price decrease. Currently, there's about 200,000 total resale condos in the marketplace. Now, if we look at this, this is the national inventory trend over time, and this shows us kind of this roller coaster of inventory that's both a mix of seasonality and also the mix of the crazy run up in prices, which drove demand. Crazy low interest rates, which pushed demand to all-time levels. We had our low March 24th, 2022 at 240,000. And when you think about that's all 50 states and the District of Columbia per state, that is an incredibly low number when it comes to housing. In fact, it was the lowest in history. Currently, we're sitting at 655, 625, and yet you can notice through that through the October, November, December, we saw some inventory start to leave the market, and we do have typically this is the time of the year that we see the biggest increases. Post-COVID, though, we've seen some trends where typically that January, February, March, people get in the market, and then April through June is the really big cycle. We've seen the sales cycle happening a little later in the years, and I'm not sure that I have an answer for that as to why that is, but it's an interesting item. Days on market, 115, up from the low of 54 days. So nationally, about 4 months. And here's your price decrease line. Long-term average is 34%. Number of homes getting relisted. We're starting to see more homes coming back on the market that had been previously on, and that's not a surprise. We're sitting at about 9.8%, but it's getting up there in terms of the highest that it's been in a while. So good time to go after expired listings. If we look at the median list price, I get a lot of questions of, are prices falling? Are we going to see prices, headed in the wrong direction? The reality is, even though we have an affordability issue, we still have some underlying metrics in terms of really low unemployment. We still have really good balance sheets. Our inventory is still relatively low, even though it feels like, especially if you got in the business a few years ago, it feels like there's just a ton of inventory. We're still only about half of the inventory we typically would have. But I broke this out into tranches so that you could see what's happening in each quartile. So the lowest quartile is the line in red, and you can see that the median list price for that group is in the, and I have two data sets on here, and I'm not sure which it was. I think it was I believe I'm working on the March 15th date. So 199, and you can kind of see how that upper tier, that upper 25% of the market, that's the market that has the most price variability. Sellers in that 1.1 and above range have a tendency to overprice or push the market a little bit. And you've got cash buyers in that range oftentimes. So it's an interesting almost tale of two markets to see what's happening with the bottom three quartiles and then compared to the top. So I'll show you how that comes into the Florida markets also. Now, I haven't shared this too much in the past, so I'm going to go through some actual Florida specific numbers today. Florida is, of course, a little higher than average in the median list price. We're sitting right at 500,000 across the state. Price per square foot, 262. Days on the market, 119. So we're tracking very similar to what's happening across the U.S. in some of those metrics. However, price decreases, we're sitting at 46%. So almost 1 out of 2 listings has had to make a price adjustment. That number just keeps creeping up, as you can see in that chart right here. We do have 7% relisted, so we do see fewer Florida sellers putting their house back on the market than we see nationally. So that may be an indicator that they're wanting to hold off a little bit. But this is one of the numbers that really stood out to me when I looked at it this month. Currently in the US, there are 655,000, I think it was, 100,000 of those are in Florida. And in fact, Florida and Texas right now make up the vast supply of the inventory in the U.S. So it's an interesting statistic. We definitely are feeling the brunt of the slowdown here more than other areas. If we look at the condo market across the entire state of Florida, of course, we're at a slight seller's advantage in the housing market, the single family housing. The condo market, we're in a little bit of buyer advantage territory, and this is indicative that insurance costs, homeowners association costs have all risen. That's pushed those prices up. Sellers are a little bit more willing to negotiate, and there's a little bit of softness in those prices in Florida. So you can see we're sitting at 350 median list price, 146 days on the market. So we're quite a bit more than what we see in the single family resale market. Price decreases 41%. So a very healthy share of the condo market is taking a price reduction. But again, this is the number that I looked at that I went, wow, 72,096. So that's a big chunk of the US market. And if we pair this together and we put it this way, when we look at the single family and the condo inventory, Florida has 20.2% of all homes for sale in the US. This is where we're feeling that pressure. That's where we're feeling the little bit of stagnation in terms of buyer demand and slower sales pace activity. So let's take a look at what I call the Tri-County area. Our market centers predominantly serve Sarasota, Manatee, and Charlotte counties. And so these are the three that I really kind of pair together when I'm looking at these numbers. What I wanted to do for this update was give you a sense of what are the trends across this area, and then we'll dive into the individual counties. And so if we just look at just the key items, and these aren't a surprise, probably. Homes, they're just taking longer to sell. Inventory levels, they continue to rise faster than in other areas. Buyer demand is slowing down, and yet prices remain stable, but we are seeing the number of price increases, the number of price reductions increasing. So I think these are important things to talk about with your sellers and your buyers. Now, if we break down some of the trends that we're seeing across all the markets. And this data, by the way, came from Broker Metrics. So it is a different data set. It allows us to export and really play with the data a little differently. So if we look at under contract days on market, so of everything that went under contract, how long did it stay on the market last month? In 2023, it was 49 days. In 2024, it was 69 days, up 40%. This is across all three counties. 2025, it's at 81 days, so it's an additional 17%. If you add those together, it's about 60% higher in terms of cumulative days on the market. I'm sorry, under contract days on the market. So it's taking longer. Month supply of inventory, which is a measurement of how long does it take what's the sales rate of inventory, and how long would it take to absorb everything that's currently on the market at today's sales pace. 2023 was 4.2 months. 2024, we hit 7.2. That was a 71% increase. So we really felt this last year. In 2025, we're sitting at 9.2 months across the Tri-County area, 27% increase. So month supply of inventory is really kicking up there without question, and we feel that pinch. The sales price to list price. So in other words, if you don't overprice a listing, what is the approximate percentage that a seller would expect to get out of the market? February 2023, things were running at 96.6%. 2024, not too far off, 96.8%. 2025, 95.4%. So even on a well-priced listing, the average negotiation is about 5% currently, and I do predict that we're going to see that expand out a little bit. Now, again, that doesn't mean that prices are falling. That's just an indicator that sellers were pricing their properties with kind of a crazy run up that has tapered off, and now we have sellers that are now we have sellers that are a little more willing to negotiate. Elise, you want to come off mute?
Yeah, there I am. This slide to me, if you don't mind me interrupting, is really interesting because I feel that there's not much of a difference in the last, from 23 to 25, yet in 23, I think we were still working on the COVID trend of prices, right? So, prices that were high. In my opinion, I don't see that there's that much difference. And you would think in the environment we are today, it would be a little lower in February 25. Is that correct?
Yep. Yeah, you're not wrong at all on that. And I think that, there's every transaction has some kind of negotiation room. We're not seeing that falling to 90% yet, but we're seeing it trend downward. So it's definitely something to watch. And if you have sellers that are coming from, well, for instance, if you have sellers coming from Massachusetts and they're still used to getting 17, 18 offers on their property, they're buying in a very different market. And that's where this data is important to know.
It's interesting. Thank you.
Yeah, absolutely. Thank you. Yeah. And if anyone does have questions, raise your hand or just come off mute. Active listings. This is a different data set. So this is everything that is a residential property that's available in the Tri-County area. 2023, we were sitting at 10,812. 2024, we kicked up over 18,000, and we're currently sitting at 22,000 in those three counties. So that's about a 70, 80, 90% increase over that period of time. And again, that's the inventory that we're feeling, which, by the way, I think it's important to note, we needed inventory. If we didn't have inventory growth, we would be in a very bad place today. And so the inventory growth is actually a good thing. It does give buyers more options. It helps keep the crazy inflationary environment at bay where you have multiple offers. And it's just like anything, when you get too few goods and you get too many people chasing it, that's when inflation happens. So 2025, we're sitting at 425 on a median sales price. That's up from about 409 and 419 for the last 2 years, respectively. We look at pending or under contracts. So how many under contracts were on the market in these periods of time? Again, to Elisa's point, it's interesting. February 2023 was 2669. Last year, 2,700. This year, 2,700. So the pace of sales have stayed a little bit consistent. However, the inventory has grown, and that's where you see a little more negotiation room, and you also see a little more extended days on market. Percent of active listings under contract at any given time. This one's a standout. February 23, we were sitting at 1 out of 4 homes on the market in this Tri-County area was under contract. Last year, it was 15.2, and this February, it's 12.4. So again, more inventory, similar sales pace, you just have a lower percentage. So if we just put some bullet points on these, more inventory simply means more choices for your buyers. When I look at this, I really think about using rate buy downs in your negotiations. The chances that rates are going to be better 1 to 2 years from now are probably 95%. So being able to buy the rate down, let them get in at a little more affordable payment today, and then refi when they get down the road, do a no cost refi. That's a really good strategy to help with that affordability. So if you have people that are just like, I'm going to wait until rates come down. Well, when rates come down, the buyer's going to come out and you're going to have a lot more competition. So let's buy it now and use a tool that can help us fix the problem. Homes are sitting longer, so sellers do have to price their properties right. And we do have stable prices, but reductions are necessary. So if we're sitting on the market, I call it the life cycle of a listing. We At the top of, it's like a clock. At the top is you're pricing it, kind of looking at what's happened over the last 3 to 6 months. At about 3 o'clock, you go out and you market it, and you're the cheerleader for the listing. And at about 7 o'clock, you put your ear to the rail and you listen for what's happening. And either we're going to find out that we're close to getting an offer, or we're going to find that we're overpriced, in which case that means buyers are choosing other homes over us. We go right back to the 12 o'clock and reprice. And all that happens about every 5 to 10 showings, or about every 30 days. And I find that's a tool that if you draw it out for your sellers, you can kind of visually show them the process of, hey, this is how the market works. Lead generation and market strategies are still key. It still matters. Get out there. There are sellers that will list their home. They are moving to other markets. We do have a little bit of net population growth happening right now. So some people that moved in during COVID required to come back to jobs. They're moving back out of the state. Let's take a look then at the individual counties and the local housing markets. I'm going to start with Charlotte County. We're going to start south and work north this time. As of March 20th, we were in a buyer's advantage in Charlotte County. So median list price is currently $420. New listings coming on the market are $424. So that's an indication that sellers are pushing new prices up a little bit over what's been out there. Price per square foot sitting at $237, and average days on the market's 136 days, so a little more than that 4-month level. Price decreases in Charlotte County, 54%. So 1 out of 2, I see Loretta's face looking at that one. 1 out of 2 has taken a price reduction. I think that's an important statistic, so you can prepare a seller for the fact that, hey, this isn't the market that we put a price on it. We got 20,000 more. This is a market that you may need to take a price reduction or two to be able to get a buyer to tempt or to jump. 5% relisted. That's obviously down a little bit, and currently 3,700, and 3,700 inventory, and we'll look at those trends just a little bit on this. We take a look at the condo market, Charlotte County. It's a little bit of a different picture. Still very much in buyer's advantage. So it's a buyer's market. Median list price $289, and if you kind of look at that trend, you can see that median list price is dropping pretty fast on the condo market. Median price of new listings $310. So again, an indication that maybe sellers are a little more aggressive in their pricing, and that's why we see 48% of the properties taking a price reduction. 142 days average. So condo market's a little up there again, and currently 1,081 condos for sale in that county. We just look at this trend over time. June 11th, 2021, Charlotte hit its low of 282. And if you think about that, how many houses there are in the county, 282 homes for sale. That was a savagely unhealthy level. Currently today, we're sitting at about 3,714. We look at days on the market, you get this kind of slow increase that we've been feeling over time. We hit the low in June of 2022 in terms of days on the market down there, and now we're sitting at about 136. Charlotte County median list price. If you look back 2020, we were sitting at pretty stodgy, pretty quiet, sleepy 274 through the run up. We had a high in 2022 of 529, and then today we're sitting at about 420, and the 7-day and the 90 days running about the same. So that's an indication things are pretty stable down in Charlotte County. Again, when I break out the segments and I put the quartiles together, this shows you what's happening in each area, and you can see the lowest quartile still continues to either be flat, but not real, not. We're not seeing a lot of reductions or a lot of we're not seeing it go backwards. But as you notice, these upper markets, and this really stands out to me right here. These upper markets, there's a little bit more volatility there, and you can see that the trends over time are changing in those upper 2 quartiles a lot more. So it also matters what price point you're in, which you guys know. Price decreases 54%. You can see the trend over time up from the low of 11.4%. If we come up to Sarasota County median list price currently 529. We're still in a little bit of a buyer's market in Sarasota, not by much, but we're a little bit buyer's market territory based on these calculations. 599 median price of new listings. I think that's kind of an interesting number when you look at that to see new listings are pricing at a higher level. So I don't know if that's an indication that we have some of that upper end inventory that's coming on the market. That could be something to do with hurricanes. I need to deep dive that number a little bit to figure out what's impacting that. Average days on the market, 113. Price decreases, we're still sitting at 53%. So 1 out of 2 listings are having to take a price reduction. Relisted 4%, not a lot of relists, and inventory. Look at what inventory looks like here on the next slide, or 2 slides for now. Condo market, again, buyer's advantage a little bit in that market also. Median list price 369, median new listing price 400. So again, that's pretty stable. 56 days. 56 is the median days in the market at 110 average, 48% price decreases. So 1 out of 2 again, we're seeing those price decreases. We look at that inventory trend. Sarasota hit the low in March of 22 at 328 listings. And today we have about 2,200. So is that 7x, somewhere in there, increase. So we're getting back to a little bit more of a healthier supply. We look at average days on the market, you see the trend over time, and you can see last fall, things kind of got a little higher and we're actually trending down a little bit. And I think this is going to be interesting to see what happens as we go into the spring market. We will see more inventory coming in, and yet being able to see days falling, that might be an indicator that buyer demand that's starting to pick up, and we're starting to get some people off into the market that have been sitting on the sidelines. So 110 days, median list price. You can see this has trended downward pretty steadily since about September. So we're currently 369. The high was March of 22 at 699, and going into COVID, we were sitting at 409. So you can see how much of a change we're at. 409, 369, not a lot of difference there over a 4-year period when we've had a lot of appreciation in most markets. Again, if we break this out, you really see the impact of that top tier market. And I think it's kind of interesting to note in this, the top tier, the top quadrant is actually accelerating on median list price, while the other 3 are kind of going backwards. So again, that may be seasonality, that may be time of year for this market, but that's an interesting number to watch. Properties with price decreases, again, we are trending back up in this case in Sarasota County. 13% in March 2022, and we're sitting at 49% today. So 1 out of 2. If we look at price decreases, I broke this out also for Sarasota. You can see that the bottom tier, the bottom 25%, they're running at about 45% of that market has taken a price reduction, where the top of the market's only about 1 out of 3. So again, the statistic matters, but then we sometimes have to dive into that to say, how does that impact this particular market that I'm listing in? So this is one I probably would put in my listing presentations and show sellers. Buyers also. Manatee County, currently 575. We are slight seller's advantage in Manatee County, so it's not really in that buyer's market territory yet. 101 days on the market average, so a little faster than Sarasota County. Median price of new listings, 575. So that's very stable. That's probably a reflection of a lot of new construction sitting in that market. The price decreases 55%. And actually, I say that in this case, the new construction data is actually not in this data set. So these are single family resales. So that's just an indicator that that market is still pretty consistent. Price decreases 55%, and we're sitting at about 2,800 total inventory. If we compare that to their condo market, we're sitting buyer's advantage a little bit in the condo market still. 319 average, I'm sorry, median list price, 365 median price of new listings. So sellers are pricing those above the market a little bit. Sitting at 118 days, so about 4 months on the market. And again, 1 out of 2 listing is taking a price reduction. Inventory condo market, 1,487. If we look at these inventory trends over time, you can see it's been a steady increase. Inventory is continuing to go up. What's interesting about this is when we look at the sales pace, when the sales pace picks up, the oddity that I expect is we're probably going to see roughly about 80% of buyers bring a listing to the market, which means that we may actually see sales pace pick up and we would see inventory pick up, and that would actually be a good thing. Average days on the market, you see the trend. We did kind of peak last fall a little bit, and we're starting to come back down a little bit, so important to know. Median list price has gratuitously changed from 857 in April of 2022 down to 319 today. So that's an interesting adjustment. And you see that trend with price decreases going from 15% back in 2020 up to 51%. It is interesting to see that the price cuts are accelerating. Again, that could be the seasonality of our markets. That could just be sellers that listed last fall that got realistic and said, hey, we know we need to make some price adjustments as we have new competition on the market. And if we break this out again, it's a little bit different. The numbers aren't quite as big, but the bottom quartile is sitting at 1 out of 2 homes have taken a price reduction. The top, it's about 37%. So it's maybe a little more likelihood of a price reduction even in the top tier properties than some of the other markets we looked at. So with that said, I think that, let me stop the share here. I think that this is a time to really stay close to your consumers, make sure that I think it's a really great time to be reaching out, asking at what rate do you feel like maybe you would want to do something? And you can start to segment those customers into, hey, these are the people that are going to do something at 6.5. These are the ones that would do something at 6.25. I also would be really talking to your lenders right now, as I said earlier, and looking at what are the opportunities for rate buy downs or using mortgage financing as a tool. And I always tell people mortgage financing or rate buy downs, they can be a tool that you can fix something, but that tool you can sometimes drop it and break your toe. So you want to use those things in a smart way. And yet, if you can move some of your buyer demand that would happen when rates fall further into this period, you can even out your income, even out your sales pace, and potentially, help someone get in a home faster than what they thought. I also think that the next, probably until that April 2nd date, are going to be a little bit of a interesting time. We may see some weaker employment data, which is unfortunate for the labor market and would be an absolute win for us because that would start to bring those rates down a little bit. We need labor to break. Even if it doesn't break, we just need it to soften. And of course, with that April 2nd tariff tap dance date coming, we don't know what to expect. Now, Trump did, of course, use tariffs back in 2018, 2019 timeframe, and he used them very specifically, and he used them in a way that didn't necessarily cause any inflationary environment. And yet, when you look back, the reality is we did see the business investment going to almost zero. They were very, very careful to not want to invest dollars because they did not know what was going to happen. So that's probably going to be the biggest factor over this next 30 to 45 days is, do we really get tariffs? Do we not? Do we have limited tariffs in certain areas? What gets exempted? And then, of course, how does the cost of those tariffs start to impact housing? I think the other thing that is happening right now that's really interesting, Trump did fire two key Fed personnel, and we're probably going to see some of that end up in the Supreme Court. And the implication of that is that Jerome Powell was nominated by Trump, so he was a Trump appointee. However, traditionally, there's a separation that doesn't allow them to fire a Fed president. They can leave on their own. They can kind of work the ref, so to speak, and put pressure on them and kind of make them look bad to pressure him into doing things. But it's really its own body. But today, Fed Powell and Trump do not see eye to eye. And that's why you see some of the commentary being having some friction between the two of them. So we're not sure what's going to happen. I forget his appointment date runs through sometime next year. So it'll just be kind of interesting to see how that drama plays out a little bit. And then just lastly, I think that as always, this is a time to stay very close to your clients, to really make sure that you're adding to your pipeline. I believe open houses in this market are an excellent way to fill your pipeline with potential clients for down the road. And I really encourage you to do as many of those as you possibly can. So we're in a good spot compared to where we were, and it looks like things are getting better. And yet we'll watch it very closely and see what happens. So with that said, I'll open it up to any questions that you guys might have and see if we can put a bow tie on anything. Questions, comments? Was this helpful? I see some head nodding yes. Great. As always, I encourage you, go take these, study them a little bit, put them in your listing presentations. Thank you, Bailey. Put them in your listing presentations. And then, as Gary says, be the local economist of choice. You don't have to be the weirdo that studies the markets like I do, but know a few key metrics and a few key items to be able to walk a client through what's happening, a little bit of why it's happening, and what the future holds. So with that said, if there are no questions, I will let you guys get about 5 minutes. Well, actually, we're right on time. So I'll give you a little bit of your day back, and we appreciate you guys being here.
Hey,
yes,
Brian,
Brad.
quick question. I was taking pictures of all your slides, which are great, but do you happen to have like copies that we could get of that? Because it's pretty specific. I don't know if I can recreate it myself.
No, please don't. We will send out, I will send out the recording of this and the PowerPoint as soon as we're done.
Okay, great. Thank you.
Yeah, we'll make that available to you. Yeah, thanks for the tip. Awesome. All right, guys, have a great day. We'll see you soon.